What's up, everybody? Michael Silva here. You're watching the Stock Market Brief Show. It's a weekly recap. Today's date is January 14th, 2022. We're just finished up on a wild week of trading. And let me tell you what, get ready to buckle up because it's going to get a lot crazier. In today's episode, we are going to be covering multiple different sections. I'm going to wrap everything up in the conclusion. Now, I'm going to have timestamps below. If you want to go back or skip around, that's totally fine. Just know that I am going to be touching on multiple things and tying it all together throughout the various sectors. We're going to be talking about the indices. We're going to talk about those earnings. We're going to go over a recap of what we did yesterday. We're going to talk about sector performance. We are going to talk about bonds and yields, dollars, and I'm going to add in some mega cap plays going into next week. And then I'm going to wrap it all together in a conclusion. Let's hop into today's show. All right, everybody, welcome back. So if you're part of the market today, everyone kind of celebrated, right? We had some green across the board, finally, right? Microsoft was up, Apple was up, Google was up. All the big mega cap stocks, they were doing quite well during this financial earnings week. However, when you really take a look at it from a week-to-date performance, Google managed to get into the green. Apple managed to slightly be in the green. Tesla, Microsoft, though, it was down. And then if you look at year-to-date performance, it completely changes. You're like, oh, opportunity by the dip? I don't know. We'll get into that today because we're going to be showing some charts and some potential setups. But Microsoft being down 7.77% year-to-date. Lucky number, baby. Let's do this. Apple down almost 3%. Google almost down 4%. Amazon almost down 3%. So some wild trading to start off the year. So to be quite honest, if you're struggling year to date so far, you're not the only ones out there. It's a very, very difficult environment to navigate. You just need to play very, very close attention to risk in times of high volatility. And when these easy plays are all of a sudden selling off, you need to really just be able to cut your risk. Oh my gosh, I forgot to even mention Netflix is down almost 13% year to date. Holy moly. You just really need to just cut your losers quickly and make sure that you're locking in gains or free rolling trades. So if a trade goes in your favor and you start making money on it, make sure that you're tightening up your stops or taking profits along the way. This is what happens when volatility is around. And let me tell you, you're going to see here in today's episode that it's not slowing down. We have a long extended weekend. Next week, though, it's even pricing in a larger move, more volatility, a larger risk range. Let's hop into the sector performance. We're going to start off looking at today, Friday, January 14th, sector performance, looking at the 11 sectors. Energy is not letting up the gas. Energy is just ripping, and I have a chart in the bonds and yields section to actually kind of show you something interesting about that. But yes, that has not slowed down. It's just in a continuous vertical, rocket to the moon there. Real estate was down 1.17%. That's been the laggard pretty much all year. And then financials was down 1%. So just, kind of sporadic overall across the board. Technology was down further, but it managed to catch a little bit of a bid back, which brought in some positivity to the markets. If you take a look at week-to-date performance, pretty darn lame week overall, right? Energy sector was up 5%. Absolutely amazing. And then communication services, up 0.16, and everything else was down on the week. Now let's look at year-to-date sector performance. So XLF is still up almost 5% year-to-date. So even despite today's sell-off, it still managed to hold second place within these sectors. Energy's up 16.23%. It's crazy. Absolutely bonkers. And we will go over some potential energy setups here soon. And then towards the bottom of that list, real estate's still down there. And that's kind of what I want to zoom in on. I want to zoom in on something about energy, and then I also want to zoom in on real estate. Just some interesting takes. I could go on and on, but I'm going to just focus on energy really quick. And I posted this on Twitter. If you don't follow me on Twitter, you can follow me there. But I'm looking at the relative strength line based off of seasonality for the real estate spider, XLRE. Relative to the S&P 500. So when the line goes down, that means real estate's doing horrible, right, compared to the S&P 500. When the line goes up, that means the real estate is doing good relative to the S&P 500. Okay, and I just wanted to call out that it is actually, this is based off a 20-year time range. It typically falls down into the middle of January and then starts picking up from a relative basis. Now that's interesting to me because if you go ahead and take a look at the relative strength line year to date, it's matching it perfectly. It came down, little pop, and then another low right there where you come in to this seasonality. You can see, came down, little pop, and then another low right there. And it's right into the middle of the month. I mean, today's Friday, January 14th. So if seasonality actually holds true, this is basically showing us that, hey, there's a strong chance that real estate actually might start outperforming the benchmark index, which is the S&P 500. So it's something to keep in mind. All right, now if you take a look at the relative rotation graph, you can see real estate has been creeping into the leading quadrant based off of 5-week tail length. And then you also have still defensive names continually just moving their little heads, squirming their way from improving to that leading quadrant. Interesting stuff taking place. Now, if I look at real estate on an absolute basis, and by the way, these aren't recommendations. I'm just sharing, some interesting stuff that I'm finding. We got a nice hammer candle today. It was a pretty large move to the downside. And then, it was one big red candle, and then it managed to bid back up at the end of the day. But to be honest, most stocks actually bid up at the end of the day. So you can see here, it did come into this previous area of resistance and this base of resistance here. And then now you can see that it was going to close down, but it managed to pull itself back up. So that's positive. A negative look though, it did crack down through this trend line. So it wasn't able to manage that, and that's not a good sign from an absolute perspective. But you got a hammer candle, not that much volume that came in, but there's a possibility here, based off of seasonality that we do potentially bounce. Or we start going down less and the S&P 500 goes down more, and that would still mean that XLRE would be performing stronger from a relative standpoint. Now, let's take a really quick look here at the relative rotation graph once again. I just wanted to once again call out there is still this defensive posturing, this rotation taking place. Doesn't mean it's going to be instant, right? We're looking at a tail length of 5 weeks, but that is what's going on. As you can see, there's been just a lot of volatility overall in the markets taking place. Okay, now I want to go into energy really quick. So energy just continues to just ramp straight up. It's absolutely crazy. And there's a lot of volume to support this move. So this is going to be one of the hot sectors to watch. And I'm going to show you, like I said, in the bonds and yields section, something that's very interesting that I found that it's a cool correlation to watch. But yeah, it just keeps moving up at some point. Which, by the way, yesterday's video, I did share that somebody bought like $1.6 million of put contracts, which could have been a hedge for a position. It could have been just an outright huge bet for a put position going into January, I think 28th was it? I can't remember the exact date, but basically to pull back down into this range right over here to make profits. So we'll see if they're still winning. All right, it's still too early to tell. But it's like I said, it's just completely vertical. RSI is getting pretty frothy here. Be ready for some sort of a pullback consolidation, and that's when we need to start looking for opportunities in the energy sector. But I wouldn't be hopping in just right here. It just doesn't make sense from a risk to reward standpoint. Now, a couple potential good setups if we start getting these pullbacks. Take a look at XOP. This is a spider for an oil and gas exploration and production ETF, but it is bumping its head right up here against this previous area of resistance. So it could potentially start breaking out here soon. I don't want to see it just go straight out of this. I would like to see this consolidate and move around a little bit to the side and then break out. I feel like that would be a little bit better. It made a pretty aggressive move to potentially pull back around 50% of that move and into this zone, 100 to 104, and then play from a bounce perspective. So that to me would also be a pretty killer opportunity to keep an eye on. Okay, if I look at WTIC, this is obviously a very important thing to watch because it makes a big impact on the energy sector. And you can see here, it's just bumping its head right into this 85, which we've been calling this 84, 83, 85 range as an area of resistance. So we'll see here if it starts to back off. Keep in mind, if it does want to pop itself up a little bit higher, it's going to do so on a negative divergence, and it's already been a very, very aggressive move. Like I said already, it's probably going to have to digest here at some point, and then we just need to be prepared to make our positions or to take a position. Let's go into the earnings recap, some stuff that we talked about yesterday. So XLF, we kind of came to the conclusion, I came to the conclusion, maybe other people did too, that it seemed to me that it would probably be pulling back. And we looked at the risk range, what the options market was pricing in, and just with absolute perfection, came down, tagged that, which happened to be this other area of resistance, and then we rallied up throughout the rest of the day. So nothing too shocking there. Let's take a look at a couple of the stocks. You can see here, BlackRock did end up going down to the downside, so it didn't do what PLBY did, where it just ramps down pre-earnings, going into earnings, and then gaps and rips. But you can see here, it tagged the lower edge, and we started to find some support off that area. Very interesting, right? Options market's pretty powerful. Citigroup, you can see here, it actually gapped down just underneath that move, and then support moved it right back up, only finishing down 1.25% on the day. Now this one was wild. This is a good thing to keep an eye on, because this is what happens when you get far out of those risk ranges, right? What the options market's pricing in, it got really far out of it, and it just resulted in some serious selling. And that's what can happen if you get outside of these risk ranges. New hedging has to take place. And as you can see, we gapped just clear through it on the downside, and then it just completely sold off. That's like basically 2 standard deviations from what the options market priced in. So that's a very, very aggressive move on some strong volume to the downside. Wells Fargo was the savior of the financial earnings sector today. 58.23 was the upper edge, and look at where we came in. Bam, we came just above it, pulled right back in, finished inside of the range as expected. And the RSI is getting a little frothy, and just pay attention. Right, that it's already been a very aggressive move. So we'll see here. This could be one to watch. So potentially, after a strong earnings on strong volume, what you want to see is give it time to consolidate, pull back, and set up again, because that could create a good opportunity. And, it's a good opportunity can come with financials, especially if the 10-year yield wants to continue to rise, which we'll talk about here momentarily. Let's first hop into the indices, starting with the S&P 500 from a weekly perspective. Weekly perspective, high wave type candle, right? Large upper wick, large lower wick. Where did we finish? Right by the 10-period moving average on the weekly time frame. Couple things to point out. I brought in some on balance volume just to show you kind of some divergences that I've been noticing. But the RSI was diverging clearly, and then you also have on balance volume diverging, and it's also cracking to another low. You don't need to read all too much into this, but it is something still worth pointing out, because if it matters, it's going to matter, and at least you can be aware of it. Now overall, we're still in an uptrend, right? Higher highs, higher lows. Whoa, that was a horrible drawing. Higher lows, higher highs. There you go. So we're still in an uptrend, and it managed to really hold this little short-term trend line right here, where it acted as support, and support. So we'll see here if we can get a little bit of a bounce coming into next week. But let's take a look at what the options market is pricing in for next week. And the options market, this is crazy. This is where it gets insane. Why I'm saying it's going to be pretty darn volatile. That is a large range. And we have a shortened trading week, right? Holiday weekend. So shortened trading week, and we have a large range of volatility. What does that mean? It means you need to just be very careful, because we're going to see a lot of back and forth and a lot of chop. From the high end, if we do get a bounce, which it's possible, with a lot of stuff kind of looked like it was setting up, 475 for the SPY on the high end, 455 on the low end of that range. Anything outside, be very careful. But other than that, it's going to be a wild and wacky week, most likely. At least that's what the options market is kind of saying. A couple of things to note is RSI, it's that little small divergence right there, and it's below 50. That's not a great sign, all right? And the PMO was definitely also a negative divergence, and it's pointing down, not quite below 0 yet, but also not that great of a sign, all right? And obviously all the volatility, it's not that great, right? We need things to settle down, we need things to tighten up, and we need to start getting some setups here that aren't just going to kind of like whipsaw around. Now I'm going to bring in the 30-minute time frames. I usually use the 15-minute time frames with the 130-period moving average, which equals the 5-day moving average, roughly, right? On the 30-minute, you want to use the 65 period, and that is the 5-day moving average just on the 30-minute time frame. All right, 390 minutes in a day, divide that by 30, et cetera, comes down to the 65 period moving average. All right, let's take a look here. The blue line is the risk range that's priced, that the options market is pricing in, and then I have the fib levels. We do have a couple of things to point out that you'll notice on multiple of the charts, on all these indices 30-minute time frame charts. Oh my gosh, I'm losing my mind here. There was a small positive divergence. We came down to the end. What you will notice is that the majority of the indices, they're below their 5-day moving average, declining 5-day moving average, and there's also that large range of volatility. So to the upside, we do have the PMO starting to curl itself over and cross over, so that's positive. RSI is still below 50 at this point in time, but if we start getting above that 5-day moving average, I think it's very possible that we come back and try to retest these levels, but we're just going to need the support of tech in order to do so. Now, if we do go to the low end, this does line up with this previous gap right here. So on the low end, if a gap fills and it's at this prior bottom and it's the low end of the range, I would say that's a good opportunity to potentially try to catch some sort of a bounce. Okay, so that's something to kind of key in and on watch from a risk standpoint, all right? Now, if you take a look at the volatility index, the VIX did start to sell off there towards the end of the day, but it is still relatively high. It's still above this area, and that area has been acting as support and resistance multiple times. So it is an area and a level to keep an eye on. Intraday, we did have a little bit of a negative divergence, and it did start going down, obviously there. So not much to call out here on this one. I would say, we talked about this contraction. Watch out. Contraction could lead to expansion. We got the expansion. Now we're expanded. Now we're going to probably start contracting here, right? Expansion leads to contraction. Contraction leads to expansion. Let's hop into the Nasdaq 100. Let's look at the weekly time frame. A couple things that I want to point out here. First off, you're going to see a lot of arrows on the screen. These right here. Those are all pointing to high volume weeks, and all those high volume weeks happen to be on red weeks. So I just wanted to call out that there's been quite a bit of volume on the selling side. So it seems like distribution, okay? Doesn't mean for certain that it's going to, start rolling itself over, but it's something to obviously call out. We did talk last week about this bearish engulfing candle right here and here, and then we talked about this evening star type candlestick formation, a bunch of bearish type looking weekly candles. We're back below the 5-period EMA, the 10-period EMA, 10-period simple moving average too as well. And we closed pretty much spot on the just above, that 30-week moving average. But overall, we are still in an uptrend, right? So we're seeing a lot of volatility, but we still have higher highs and higher lows. So the uptrend, right, still remains intact. Now, if we start getting below this 350, that's going to be a little bit different of a story. Let's hop into the daily time frame and look at the risk range. Risk range is up to around that pesky little 390 level and down to a low to around that 370, which is basically the same range. It's slightly smaller than last week, but it's pretty much the same thing. Okay, so we could very well see the same thing take place where we hit a low end, hit the upper end, whatever the case may be. Okay, let's take a look here at the 30-minute time frame to get a good sense of what might be taking place. First off, to pay attention to, we had that positive divergence. We got the pop. We closed beneath the 5-day moving average. So bears, have the opportunity to continually suppress and sell off this market on the declining 5-day moving average still that's holding. On the low end, we could potentially, like I said, reach around this 370, which could be a double bottom. But from a high end, we have the RSI trying to get back above that 50 level. We have the PMO starting to curl itself over. So if we start getting above that 5-day moving average, recapture the 38.2 fib, it's very possible to come in to this range. And that, looking at some of these mega cap stocks, I can definitely see that as a possibility. So it's something that we need to at least be prepared for. Let's look at the Russell 2000. Okay. IWM. The IWM hasn't been going anywhere. This candle right here, it's an indecision candle on a down move, right? So it's basically saying like, okay, do I want to go off? No. I want to go higher. No. And then it closed basically, untouched for the week. It was down 1%, but from open to close, it basically remained the same. Now it is below all these key moving averages, being the 5, the 10, the 40, the 30 week moving averages. And I wanted to call out this on balance volume. So first and foremost, when this was breaking out, there was a lot of excitement. On balance volume did not confirm the breakout. And that was kind of a telling sign. We also saw multiple different divergences. So it was like, okay, proceed with caution is what that stated. Okay, and it ended up coming back in. Now we're at the lower end of the range. Okay, and what I wanted to call out here was on balance volume actually did break down from this. Now it's very slightly, very subtly. Okay, so you don't need to put too much weight on this. But it is just a heads up notice. We did not break down. Price is not confirmed, but on balance volume is moving, beneath that, and we're below all these key moving averages. It sets up for, a pretty nasty move to the downside. I don't necessarily know if that's going to be next week or not. Once we go into the other time frames, you might actually think that we could be potentially getting a rally here, and I'll show you why. So on the daily time frame, we gapped down, we headed lower, but then we closed within the previous trading day and closed pretty much at the upper at the high of the day, right? So we jammed right back up to and closed at the high of the day, having like a little shaved headed candle there. And sometimes those type of candles get follow through, get a pop to the upside. So the options market is saying this: the risk range on a short trading weekend, we can come up to around 220 and a potential as low as, just above 208. So on the downside, we're tagging a previous area of support where this channel has been for a year. But on the high end, we could potentially come retest these previous little areas of resistance, which is still below these key moving averages. So that's a strong possibility. If IWM wants to rip right here, the rip and the rally would just be potentially right up to 220. Okay, so keep an eye out for that. And also, what's crazy is a lot of these moves that's been taking place, it happens on Monday for some reason. That's what we've been seeing. I'm not saying like that's going to happen or I'm predicting that to happen. Technically it would be Tuesday, but because it's a shortened trading week. But what's been happening is like it's the first day of the week, maybe the second, hits that expected move right out of the gates. And it doesn't really set up an opportunity to trade it. And that could very well be what happens next week. All right, so we'll just keep your finger on the pulse, or whatever the saying is. So let's look at the 30-minute time frame here. Excuse me, it's below the 5-day moving average. It is declining. We saw that jam up on pretty much everything towards the end of the day. And, that was a positive sign because, maybe if it jams up, maybe that's how it's going to follow through when the market opens up. If that's the case, cool, but just pay attention, right? We were overextended, and now it's jamming up with the PMO indicator is curling itself up, but it's still below zero. All right. I would say that if we can recapture this 5-day moving average, it's more than possible to shoot right back up in this range. I just don't see that being an issue, given that it has multiple days to potentially get there. So we'll keep an eye out for that. Bonds and yields. Let's hop into this. This is where things get a little interesting. So bonds and yields up overall. If we take a look at the 10 and 2, the 30 and 5, flat. It's not going anywhere. It's not doing anything. What I found very interesting today was that the 10-year yield, I'll show you on the daily, but on the weekly chart, we did break out of this, and then we kind of just had an inside trading candle here. And the inside trading candle can lead to more upside if we get above 1.8. If we start getting above 1.8, as the PPO is starting to curl itself back up, it looks like it's poised to actually move higher. So that's what we got to pay attention to. Now, if this moves higher, that's going to put pressure on tech. You would think, at least. But this is where it got interesting. The 10-year yield today was up 3.57%. So it pulled back and it started rallying. And you know what wasn't affected? Tech. Tech was not affected. Tech actually rallied into close, right? The XLK, the spider, the technology sector, it ended up being one of the top performing sectors today, despite seeing a pretty large move there in the 10-year yield. So, maybe it's going to be a delayed reaction. We've seen that plenty of times. Maybe they didn't react poorly because they're working off overextended areas because they just did go through a pretty large aggressive move to the downside. Let's look at TLT. So the TLT potentially on the weekly time frame is cracking down through this channel, this bear flag potentially. Okay, we're below those key moving averages. You can see that we kind of try to retest it, and then we sold off. Pretty large move, and the PPO is starting to curl itself over, but we're well above zero. Well, not well above, but we are still above zero. Now, I was stopped out of my position, break-even trade. If it sets up again, I'll take the trade, but as it stands right now, just be careful here. This is interesting because the yields are going up. Tech wasn't affected today, and there's a lot of volatility being priced in for next week. Not only, right, for, the indices that we're talking about, but look at TLT. I brought up the options, what the options market was pricing in. It could come up to around 144, or it can break down to around 140. Now, if it breaks down like that, and that's, hits their next week, that's where this prior area of support is. I would feel like the tech market would, technology stocks would feel that impact. I would think. So keep an eye on that. Now, if it starts rallying up to this area, perhaps that lends to some relief. Now, the thing that I wanted to show you about the energy sector, I'm looking at up here. Up here is a relative strength line between energy over SPY. So when this goes down, energy is underperforming the SPY. When it goes up, SPY is underperforming energy, or energy is doing better. So when the line goes up, energy is doing better. When it goes down, energy is doing worse against the benchmark index. Well, down just beneath this is the 10-year yield. Boom, boom. Look at this correlation. When the 10-year yield goes up, well, energy outperforms the S&P 500. And you can see really, here, it's been a pretty darn tight correlation. It's not perfect, but it's pretty darn good, right? Little head and shoulders, potentially a little head and shoulders right here. So the reason why I'm pointing that out is because if the 10-year yield backs off, that is when probably you'll see energy start to underperform the SPY. And energy has been on a monster move, okay? And the 10-year yield has been on a monster move. Now, this last trading session, the 10-year yield went up and tech went up. So somebody's lying, right? Somebody's going to respond. And if the 10-year yield does want to back off, which looking at just the price action, it looks like it could head a little bit higher. And if that's the case, maybe there's a little bit more weakness. But if it does start to back off, perhaps energy is the one to then start that consolidation or pullback, and tech catches some relief from this horrible start to the new year. Let's take a look at the dollar. I know, right? That was pretty cool. At least I think it's cool. US dollar. This is the weekly time frame. We tagged that move, the one that we were talking about way back here. And then we're starting to sell off, all right, or pull back. PPO on the weekly time frame did have a bearish crossover, so that's something to watch. If the dollar goes down, guess what? That makes a good bet for gold and silver, which gold and silver, by the way, I'm making a video come out on Tuesday morning to dive into the gold and silver market, and I'm doing it separate because I got a sponsor to sponsor that video, and I want to go more in detail on a separate video, and that, because they're supporting the channel, I'm going to do so. Let's hop into the daily time frame. The daily time frame, we talked about it potentially breaking down and catching a little bit of the bid, the USD or UUP, and we did. So we ran back up. Okay. Nothing wrong with that. Now, where can it go? Well, let's see it try to get back into this channel where this could be a little bear trap. Or if 95.50 is going to be a retest and it's going to head lower. Now, if this goes lower, that could be good for obviously gold, silver, and it could also be good for the S&P 500. Because we've seen many times where the dollar falls and the S&P 500 tends to rally. Okay, but when we see a large move to the upside in the dollar, for example, right here, boom, that was a large move. The S&P 500 struggles. Okay, so it's something to obviously pay close attention to. Let's hop into some mega cap stocks going into next week, where I'm going to bring in the ranges on the 30-minute time frames. All right, now this is where it gets a little bit interesting. Okay, these are just highly liquid names and potential trade setups. They're large ranges, so shortened trading week, where could we potentially go? It doesn't mean that these are going to be resistance and support and we're going to tag these. That's not necessarily the case, but let's just take a look at it. It's going to be a volatile week. You might need to increase your stops, like size of your stops, and you might need to reduce your position size because it could be a little bit more wacky, like this day, right? Just a big old gap down and then just rallied up. So this actually, to me, red to green is pretty bullish. So I'd say, being that it's back above the 5-day moving average and it's starting to flatten out, Facebook might be one to watch. The PMO starting to curl itself back up. RSI's back above 50. Hello. Perhaps if it starts getting above this little pivot area or potentially this little pivot area, that sets us up to try to come into the upper level of this risk range. Okay, and that's a pretty aggressive move in a week, right? 331 to around 344. Yeah, you can make some good change there if that's the case. Now on the downside, obviously you can come down to around 320. So those are the levels that I'm watching, but I just wanted to share the setup. Now, something to keep in mind with these, the majority of these names that I'm going to go through. So for example, like this one, the trading day, it looks like a piercing type pattern. And what I mean by that is it went from red, gap down, to green, closing around the high. So it's a pretty bullish looking type pattern from a short-term perspective. All right, let's take a look at Apple. Apple's actually below that 5-day moving average, but it is flattening out. So if we start getting above it, that could be a good sign that we can go test this 176, 177, or potentially even the higher end range. The PMO, it's starting to curl itself back over. That's positive. RSI is getting back above 50, also positive. So we could potentially see a little bit of a rally there. Now, another thing that I want to call out that I haven't done yet is this was a very aggressive move, and this was a pretty aggressive pullback. What do you notice? The pullback was about 50% of that move. And you can typically see bounces come from those levels. You can typically go boom, pull back 50%, and 100% rise from that level would take us to around this area. A little bit more. All right, but that is something to pay attention to. And the same thing goes with Facebook, except Facebook was a little bit more dramatic because of the open. All right, let's continue on to Tesla. Everyone loves Tesla. All right, so Tesla, 5-day moving average, it was flattening out. Boom. PMO, curling itself back over. That's positive. But it's still below that 5-day moving average. It's pricing in a potential move up to around here. And remember, this range right here, the options market is saying, okay, 70% of the time, we're going to close within this range. Okay? It doesn't mean that it's going to come up here or come here. It could go like this. Boop. That's always a possibility. So we're just looking at the levels, and the levels happen to be this previous area of support and this previous area of resistance. I think it's very possible that we go test one of those coming in next week. So if we start getting above that 5-day moving average, I would start looking at this as a bullish move to the upside. If we start getting below this little area, 1020, then I'd say we start to go potentially test this. And always look for a possible undercut. So if we come down low and undercut it, but then we come back up, bam, watch that. Because then we could come right back into the middle of the range or potentially higher. So that's another thing to potentially watch out for. Okay, let's go to NVIDIA. A lot of people like NVIDIA. Now this 5-day moving average, it's declining more. All right, and we got that pretty, nasty gap down. We moved up, we came down, we moved back up. PMO is starting to curl over, cross over to bullish. RSI is slightly still under 50. Yeah, and it's basically pricing in just an area of resistance up here, area of support down here. Out of all of them, this one's not my favorite, but there's still potential opportunity if we start getting above this 270, 250, which happens to be, right here too. I would say that's very possible to come up to this upper range. So that is one thing to watch out for. Now, if we start breaking down through this through 262, start looking to retest 250, 750. Google, this one looks pretty good too, right? Big gap down. Buy the dippers came right back in and started getting faded on a little bit. But overall, red to green candle, up slightly for the day. PMO is starting to kind of curl itself over. RSI is still below 50, but it's trying to build up right there. 5-day moving average, it was a steep decline, but now it's starting to curl itself back up. You might be able to just look at this very tight pivot right here. If we start breaking out, start to target up north. Now, if we start breaking down lower, start to target 270.40. That can potentially act as an area of support. If that starts to give way, right here, risk range, okay? All right, Microsoft. Microsoft did have the bullish crossover on the PMO, but also, similar to NVIDIA, big declining 5-day moving average. You can see here, big green start, and then it started to flag consolidate and then closed just around the high of the day. So, it had a lot of time to kind of flag and base right here. And this kind of firepower can take us at least to the 5-day moving average and maybe potentially start to flatten it out. So this is also another one to watch, right? Microsoft has been doing good for quite some time, including all last year. Now, another kind of thing to note here is you can see positive divergence. Bam. You have a low, a lower low, a low, a higher low during a bullish crossover. So that to me sets it up for a potential move if we can get back above this 5-day moving average to hit up into this range. I think that's a strong possibility. We need more data, but I'm just kind of drawing, kind of my thought process here. All right, let's wrap this up with the conclusion. So first and foremost, the market's pricing in more volatility. When the market prices in more volatility, you need to reduce your exposure. You need to be more careful, be more tactical. Maybe reducing your exposure means reducing position size so you can expand your stops a little bit. Or maybe just keep hitting these little, nicks and cuts where you're just basically kind of just bleeding out because of whipsaws. The market's pricing in the volatility. It's not going anywhere yet. So you just need to adapt to the current market conditions. Now, if you have a strategy that's working for you, that's great. All right. Now, I want to also, because this episode sounded a little bit more bullish based off of, just it looks like we can potentially bounce. Like it's very possible. It's very possible to fall. But I want to just overlay this once again with this chart and a couple others. All right. The Nasdaq, the percent of stocks above the 200-day moving average, only 25.85% of stocks are above the 200-day moving average based on this index that has, 3,300 stocks or so in it. Meanwhile, the market's still not far from all-time highs. We barely have seen a market sell-off. Now, if tech starts to give way, that's going to be a big difference, right? We're going to see a big thing happen here. But it just hasn't happened yet. So are we going to have, just like we had a stealth bear market, are we going to have a stealth bull market? We don't know yet, but just think of this as termites just chewing away at the foundation. All right, so the reason why I'm bringing this up is because once again, you must be careful. This is taking place, volatility, it's here. You need to be very careful. Another chart is this chart. We're looking at Nasdaq new lows. And I'll zoom out here momentarily. But just look at all these new lows that are building, around 10% off the all-time high. Right? Almost 10% from an all-time high. You have just huge spikes of stocks making all-time lows or brand new lows, 52-week lows. Okay? And you can see that here on this chart. And this is just a different way of looking at it. Today, we almost had 700. So we had 679 new lows today. And today actually was up. It's crazy. All right. And now if you zoom out, when's the last time you've seen these type of new lows take place? Really, you got to look back super far. I can zoom out even further, but I don't need to. The last time this happened was they started building leading up to this pandemic. And then actually a pandemic took place, and then we got huge spikes. But what's crazy to me is, we're apparently coming out of the pandemic. I don't know about all this Omicron stuff. You would think that things would be getting better. It doesn't, it's for other reasons. Like things are blowing up, and this could be because of Fed policy taking place, QT. We raising rates, we're cutting back bond purchases and so forth. Could be Omicron, could be, a bunch of things. But, everyone's looking for the why. It doesn't matter. All we have to do is look at the data. This is taking place. So what does that mean? It means you just got to be careful. That's it. That's all you need to do. Stop rushing into trades to try to make money back or to make a lot of money. You should always, always focus on risk. You cannot change that. Record all your trades, analyze your trades, pay very close attention. If you don't like being next to the computer all day, then, start looking at larger time frames and start creating low risk entries on larger time frames. So you don't need to be worried about all this volatility. That's all I got for you, everybody. Hope today's episode helped out. See you later.